So good afternoon. Today we'll be discussing the unit 4, that is forecasting foreign exchange rate. So till now we discussed what is foreign exchange rate, what is the structure, who are the participants, the triangular arbitrage, cross exchange rate, and we dealt with all other things. So today we'll be dealing with the foreign exchange rate, that is the forecasting foreign exchange rate. So why do you think forecasting is very much important? What is forecasting? So forecasting is nothing but estimating. So estimating or predicting the future values in the international market, how the exchange rate will be. So we are going to estimate, we are going to predict our future currency value, so relative to one another. Like we are predicting the dollar rate, we are predicting the Great Britain pound, or we are dealing with Japanese yen. So this is what prediction. So how the rate will be. Take for example, today the US dollar, one US dollar equals 85 rupees or 86 rupees. Then we are predicting for the future, so whether it will be 89 or it will be again 84. So we are that predicting the foreign exchange rate. So it is very crucial in the international business or the investment decisions or in the policy making or in the risk management. So this is why forecasting of foreign exchange rate is important. So you can see exchange rate movement can affect the economic activity, that is nothing but buying and selling, and the inflation is also a part of this foreign exchange rate. Based on the inflation also, the foreign exchange rate will volatilate. And even in the balance of payment and like export import, in every stages the estimation is very much important to reduce the loss or to make a risk management. Next, so here we are going to measure the foreign exchange movements. So for measuring the foreign exchange rate movements, we have some crucial methods. So that is percentage change in exchange rate. So percentage change in exchange rate is the simplest way to measure the exchange rate movement. So where we are going to consider with the formula percentage change equals P1 minus P0 divided by P0 into 100. So P1 represents the exchange rate at the end of the period, P0 represent exchange rate at the beginning of the period. So if we apply the percentage change formula, then we will arrive at what is the change in the percentage. So that is one method to calculate the change between two time periods of exchange rate. So next we have nominal exchange rate movements. So nominal exchange rate movement is nothing but is the direct exchange rate between two countries without adjusting for the inflation or any other economic factors. So here what nominal exchange rate movement does, here they are going to find out the direct exchange rate between two countries without adjusting for the inflation. Here they are going to not consider the inflation or any other economic factors. Only exchange rate is considered rather than inflation or any other economic factors like interest rate or anything. So we have appreciation of currency and depreciation of currency. So appreciation of currency is nothing but when a currency increases in the value related to one another. So we'll give an example for what is appreciation. So appreciation is nothing but, take for example, 1 US dollar equals 86 rupees. That is a current rate or the spot rate, we can say it. So if tomorrow the currency rate 1 US dollar equals, say for example, it might be 89 or 90 rupees. So there is an increase of 3 rupees. If that is the case, it is called as devalued or depreciated. So don't consider it has been increased because the spot rate is 86 rupees. Tomorrow the rate becomes 89 rupees. There is an increase of 3 rupees. But that is not considered as appreciation. So that is depreciation. So appreciation is nothing but if the currency rate 1 US dollar equals, if it is 83 or if it comes to 80, that is called as appreciation because the value of Indian rupee is increasing. That is called as appreciation. Depreciation is nothing but if the dollar rate for Indian rupee increases. So if it is increased from 86 to 90, 95, that is depreciation. If it is reduced from 86 to 80 rupees or 75 rupees, that is called as appreciation. So that is what appreciation and depreciation. So appreciation is nothing but increasing the value. Increase in the value is nothing but our, compared to the US dollar, our currency should decrease in the value so that our value will be increased. So depreciation is nothing but if the US dollar for Indian rupee increases, then it is called as depreciation. Next, cross currency exchange rate movements. So cross currency exchange rate movements are nothing but you're going to compare with a cross currency with each other so that we will have an exchange rate, and we are going to connect it to the third currency. Take for example, we'll have a exchange rate between the Indian rupee as well as US dollar. Then we are comparing that rate to the pound sterling, to the third currency or with the cross currency. That is what the one more method. Next we have a real exchange rate moment. So in the real exchange rate, it is nothing but the nominal exchange rate for differential in price levels between two countries. We know in the nominal exchange rate moment we are not considering the inflation rate or any other economic factors, but in the real exchange rate moment we are going to consider the levels of inflation between the two countries, because it is more accurate measure of the relative value of the currency. If inflation is not considered, then what happens is we are not going to get an exact value of what is exchange rate, what is the exchange rate value. So when you are considering inflation, that is nothing but the real exchange rate, then we can get the accurate measure of the currency or the value. We have a formula: real exchange rate equals nominal exchange rate into domestic price divided by foreign price. Domestic, if you are in the Indian perspective, then obviously domestic price is nothing but Indian rupee, the foreign currency will be US dollars. And if it is in the US perspective, the domestic country will be US and the foreign currency will be India. You need to look into the on which perspective the question is going to have. So the real exchange rate is nothing but real exchange rate considers the inflation value, but nominal exchange rate will not consider the inflation or other economic factors. Next we have exchange rate equilibrium. So equilibrium is nothing but it is a point where the demand and the supply will match. So you can see here the flexible exchange rate is determined by forces of demand and supply of foreign exchange in the market. In the market, based on the demand for the currencies and the supply of the currencies, exchange rate will be determined. So at the point you can see in the diagram, at the point E represents the equilibrium point. When R1, that is nothing but rate of foreign currency, increases from R1 to R. So if it is decreases from R to R1, again there is a decrease of Q to Q2. Then if the for rate of foreign currency increases from R to R2, then it increases from Q to Q1. You can see the exact moment. So when the demand increases, has the supply is also increasing. So that is nothing but the point E is nothing but equilibrium point where there is equal demand and the equal supply. Next we have factors affecting the foreign exchange rate. So factors, there are various factors. In that we have the interest rate. The higher interest rate, so what does higher interest rate and the lower interest rate effects? So these are all when you are determining the foreign exchange rate. So these are the factors which are going to affect a country currency. So interest rate is nothing but if there is a higher interest rate in the foreign exchange market, then obviously it attracts the investors from other countries to have higher returns. Take for example, if India is giving more interest, what US people will do or what Britain people will do, so all the investors from all over the world will come to India, they will start investing on India. The reason is very simple: they will get more of returns or the more of revenue. If they are invested 100 rupees, they will get 150 rupees if the interest rate is 50%. That is why if the interest rate is high, then obviously it will attract more of foreign capital. If you have a lower interest rate, so if you have a lower interest rate, take for example India is having the lower interest rate, obviously what happens, no persons from the world will come and invest on your country, so that the flow of currency towards India decreases. So wherever there is a higher interest rate, that country will attract more of capital. Wherever there is a lower interest rate, then obviously it will have a decrease in the demand for the currency or decrease in the investments from the world. Next, inflation rate. So as you know, inflation is nothing but decrease in the value of money. That is what the inflation represents. So if the country is having low inflation, if the country is having low inflation, then obviously it will If there is a low inflation, obviously it will attract more of foreign currency. So because why it attracts, when the inflation is low, then obviously the services will be cheaper, the goods will be cheaper, then obviously it will attract more of investors. As I said, if there is a high inflation, if there is a high inflation means the prices of the goods and services will be higher, then it will reduce the investments. That is what inflation does, the higher inflation does. Inflation means it will attract more of capital. If it is a high inflation means it will decline the investments. Next, economic growth. If there is a strong economic growth in the country, as you all know, the India is developing country and the economy is very stable. At that time, it will attract more of foreign investors towards the country. That means the foreign investment will increase. So if there is a weak economic growth, then obviously people will not invest on the particular country which has a lower economic growth. Next, political stability and economic performance. So political stability, if there is a political stability in a particular country, take for example any country all over the world, if there is a proper stability in their government or if in their political environment, then obviously it will attract the more of investors. Because since the stable government is there or the stable political system is there, then obviously it have a good investments in a country. If the country is unstable, then obviously people will hesitate to invest on particular country, so that it will reduce the investments, because they are the risk averse people. Next, balance of payment. So as you all know, balance of payment is nothing but when exports is more than the imports, when the country exports is more than the imports, that is nothing but the current account surplus. In that time, it will lead to an appreciation. There will be a greater demand for the currency. But when there is a current account deficit, at that time our imports are more than the exports, then obviously it will lead to decline in the investments. That is what the current account surplus and the deficit does. Next, government debt. So there is a, if the country is having more of debt, at that time it can lead to pressure and fear of default, reducing the confidence. As you all know, in India we have more than like 186 point like 79 lakh crores. It is 196 lakh crores in the particular year of 25 and 26. So if take for example, if that increases to 200 lakh crores or 300 lakh crores, at that time our country will have more of pressure and more of default will happen, then the confidence will be reduced. If there is a lower debt towards the country, take for example the Indian debt reduces from 196 to 100 or 50 or no debt, at that time people will have confidence and the risk is also very less, so that you can attract our foreign investments. Next, we have speculation. So currency speculation is not but we are going to speculate or forecast or estimate the future value based on the future moments or expectations. If the speculators believe the currency will strengthen, they will buy more. Speculation is nothing but we are going to have a thinking that in the future this kind of possibilities can happen. So if the possibility is the increase in the currency value is means we'll have more of investments in the currency speculation. If we have the, if it is if it is the value is decreasing means, then obviously people will hesitate to buy it. So that is what happens. If you have a speculation of the currency value will increase, then obviously we can attract the investment. So if the currency value will depreciate, if you are having a thought of the currency value will depreciate, then obviously the investment will be decreased. So then we have the trade relation. So trade relation is nothing but if you have a favorable trade balance, as I discussed in the balance of payment, then obviously we can increase the demand for a currency. Then the trade policies also, tariff quotas and the trade agreements can impact the demand for a currency on influencing the trade flows. If the tariff or a quotas are very less, if there is a stable policies of trade, then obviously we can have a good impact on, or we can increase the demand for a particular currency. Then if in some conditions, if the trade and tariff or the tariff or the quotas are more, then obviously we'll have a declining impact on the particular investments. Coming to the global events, so take for example the natural disasters. So this is a event where it will impact on the economic activities and it reduces the investments. Take for example a country will have a natural disaster like heavy rain or the floods, or we can say volcano. This kind of the natural disaster happens for a particular country, then obviously we will hesitate to invest on that particular country because the country is facing some natural disaster and the demand for that particular currency will decrease. So this is also one of the impact. Next, geopolitical tensions like conflicts, war, diplomatic issues. Take for example, the best example is the today's war like the Iran and Israel, and it might be the Russia and Ukraine war. At this kind of conflicts or the war happens or the diplomatic issues comes, we'll have a geopolitical tensions and the demand for a particular currency will decrease. Next, market sentiment. So investor confidence. If there is a positive news on the particular market, then obviously we can expect the currency appreciation towards the investors. The risk aversion. The risk aversion is nothing but we're going to have a safe players. Risk averse is nothing but reducing the risk. So based on the global news, then if they want to invest they can invest, or if they feel that it is very risky, then obviously people will hedge to invest, or the people will hesitate to invest on that particular currency. Next, we have forecasting foreign exchange rates. We have three methods, so where you can anticipate the currency movements. One is the fundamental analysis, one more is the technical analysis, and the market based models. So in the fundamental analysis, so it involves evaluating the underlying economic, financial and political that influence the exchange rates. So this method assumes that currency values are driven by macroeconomic events or the variables. It might be the inflation or the GDP or the trade balance or the balance of payment or whatever it is. So you can see the key factors we have: the political stability is there, the interest rate differential is there, inflation rate is there, economic indicators are there. So these are all the economic indicators, nothing but the GDP growth or some other things. So these are all the key factors which are used in the fundamental analysis to identify or to forecast the values. Example we have: if the US Federal Reserve raises interest rate while the European Central Bank maintains or lowers its rates, there is nothing but the USD might appreciate against the euro based on the interest rate differential. It says that interest rate differential is one of the factors in determining the fundamental analysis. And the fundamental analysis considers only the macro factors. So technical analysis will focus on the microeconomic factors. It uses the historical price data or the chart patterns or the technical indicators. It might be the candlesticks or the line or the bar charts. So we have the trend lines, the moving averages, relative strength index. So these are all the key tools which are used in the technical analysis to forecast the foreign exchange rates. And we have an example: the technical analyst might observe that the USD or the euro exchange rate has repeatedly bounced off a certain level, and it will predict to what extent or what level it can go. That is what it is. So using the technical analysis, that is the micro factors, we are going to identify what exactly the increase or what is the decrease or the estimation. Next, market based model. So market based model is nothing but it is a model where it uses the current data such as interest rate and the forward rates and the option prices like put option or the call option prices to forecast the future exchange rate. We have the approaches like forward rate, that is nothing but it's a contract, it's a contract rate. Then the international parity. Next we have interest rate parity theories that we'll study in the later slides. Then the option pricing. So these are all the key approaches we used in the market based models where it uses the current market data. Next we have international parity relations. So it is also known as internet international parity conditions, or it is like an economic theories that links with the price levels or the interest rates. And we have different various parity relationship. So under that we have the interest rate parity or purchasing power parity, as well as the international Fisher effect. So these are the main three theories of the parity relations we will study. So it is a theory that explains the differential between the interest rate of two countries remains equal to the differential calculated using the forward exchange rate. So what it exactly says is nothing but the differences of. So the concept is very simple. The difference in the interest rate between two countries is equal to the difference between the forward exchange rate as well as the spot exchange rate. So take for example, the best example I can give is, take for example, in India, if the interest rate is 15%, and in US, if the interest rate is 10%, in India there is a increase of 5%. So what you can think, we can borrow in the US market, then we can invest in the Indian market with a 5% more interest. So you can say that we can gain of 5% in Indian market. So that is not possible, because you borrow for 10%, you will invest in India for 15%, you gain for 5%. That 5% is not possible because the rate of currency will not remain constant. Take for example, you borrowed for 10% in US dollars, and you invested in Indian market for 15% interest, and don't think that you can get a profit of 5%. That is, US has 10% interest, India has 15% interest. You can't make a profit of 5% extra, because the rate of exchange will not remain constant. After 1 year, that differential will be resolved, that be compensated by this interest. This 5% interest is compensated by the differential. That is what this theory says. So according to this theory, there will be no arbitrage in the interest rate differential between the two countries. You can't make that 5% profit, because it will be compensated, or we have no arbitrage. So next we have purchasing power parity theory. So the purchasing power parity theory, it was propounded by Gustav Cassel in Sweden. And according to this theory, this theory says very simple: the exchange rate between two countries depends upon the relative purchasing power of their respective currencies. As I said, take for example, 1 pound of bread cost 80 rupees in India, and in the US the same 1 pound of bread will cost around $1. And if that basket of product will have a same value in all over the world, here it cost 80 rupees, but in US it cost $1, and it will cost it will cost like 95 in Britain. But when you are compared with the relative purchasing power, so same basket of goods can be purchased anywhere in the world. That is the concept of purchasing power parity. Next we have two types of purchasing power parity. One is absolute purchasing power parity, one was relative purchasing power parity. So absolute purchasing power parity, the exchange rate between two countries are equal to the ratio of the price levels in the two countries. So in the absolute level, there is an equal of two currencies with the price levels, but in the relative purchasing power parity, the rate of change of exchange rate is over the time and equal to the difference in the inflation rate. In the absolute purchasing power parity, it will not consider the inflation, but in relative purchasing power parity, it considers the inflation. So next we have international Fisher effect. So international Fisher effect states that the nominal interest rate in the country is equal to the real interest rate plus expected inflation rate. Here they are considering three aspects. One is real interest rate, and nominal interest rate as well as the expected inflation rate. First of all, we'll learn what is nominal rate or nominal interest rate. So nominal interest rate is nothing but it's a financial rate from the bank. It might be like 5% interest for deposits or the 5% interest on bank. So then normally where the inflation is not considered here, just the financial return from the bank is given. So coming to the real interest rate. So here the inflation is adjusted. So inflation adjusted nominal rate where the inflation is considered for the rate. So take for example, real interest rate equals nominal rate minus inflation rate, or you can do vice versa. And we have a formula, forward rate divided by spot rate equals 1 plus RH, that is exchange rate of host country divided by 1 plus RF. RF is nothing but the foreign country. That we will discuss in the problematic part. So next we have arbitrage. So arbitrage is a foreign exchange market. It is a strategy basically used to gain the price advantage, price differential advantage. Take for example, there are two markets. If there is a price differential, then we are going to take advantage of arbitrage. You can see it here, buying and selling of currencies at different prices to make profit from the price differentials or price differences. Take for example, two markets are there. For example, you can take it as Bangalore market as well as Mysore market. The price of tomato in Bangalore market is 50 rupees, but in the Mysore market it is 25 rupees per kg tomato. So what you will do, you will buy in the Mysore market for 25 rupees per tomato and you will sell in the Bangalore market for 50 rupees. Understood? There is a price differential between the Bangalore market and the Mysore market, so that you will take the advantage to make the profit. So that is the arbitrage. And there are types of arbitrage in the forex market. One is locational arbitrage. It is like the normal arbitrage process where we are going to, the currency is priced differently at two different locations or banks. So here the different locations or the bank, the price is differently quoted, and traders or the investors are going to buy the lower price and sell with a higher price. That is what the locational arbitrage. Here we are given the example. Assume a bank in New York while bank B is in London, and you can observe the rate. Wherever the rate is low, we are going to buy there. Wherever the rate is high, we are going to sell there to make the profit. The difference. So triangular arbitrage involves taking the advantage of the differential between three countries. So it requires converting an amount from one currency to another, then they can convert it into third currency. As I said, we have dollar, euro and pound is there. Once the transaction between the dollar and the euro happens, again the euro and the pound sterling happens, again from pound sterling to dollar. It goes in a triangular basis. So that in that cases we are going to make a profit taking the price differential. Next we have covered interest arbitrage. So covered interest arbitrage is nothing but here they are going to consider the difference of interest rate of two countries along with using the forward contract to eliminate the exchange rate risk. So forward contract is nothing but it's a contract between two parties where they are going to agree upon the future price, and the every details will be contracted today or represented today for a future basis. So that is what the forward market. In the covered interest arbitrage, they are going to take the differential of interest rate of two countries with the help of the forward contract to eliminate the risk. That is what the covered interest arbitrage is. Thank you.